Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Profitability Index Explained, a simple guide for smarter investment decisions. Making smart investment decisions often comes down to understanding the numbers. That's where the Profitability Index, PI, shines. This simple yet powerful tool helps you measure the value of potential investments by comparing their benefits to their costs. Whether you're managing personal finances or corporate funds, PI can guide you toward better choices. In this video, you'll learn what the Profitability Index is, why it matters, and how it can streamline your decision-making. What is Profitability Index? The Profitability Index, PI, is a straightforward financial tool that helps assess the value of an investment. By comparing the benefits an investment generates to its costs, it gives you a quick snapshot of whether a project is worth pursuing. Investors and businesses use PI to prioritize projects and allocate resources wisely. If you're looking to make financially sound decisions, understanding PI is a must. Definition of Profitability Index. The Profitability Index is a ratio used to determine the potential return of an investment relative to its initial cost. Essentially, PI answers the question, for every dollar I invest, how much value can I expect to receive? A PI greater than 1 suggests the investment is likely profitable, as the benefits outweigh the costs. A PI less than 1 hints that the project could lose money since the costs exceed the benefits. It's a handy way to evaluate multiple opportunities and decide which ones are worth pursuing. Key takeaways. PI greater than 1. The project is expected to generate more value than it costs. PI equals 1. The benefits equal the costs, so there's no real gain or loss. PI less than 1. The project is likely not a good investment. Formula for Profitability Index. The formula for calculating PI is straightforward. Profitability Index, PI, equals present value of future cash flows divided by initial investment. Let's break this down. Present value of future cash flows, the total value of all future cash inflows from the investment, discounted to today's dollars. This considers the time value of money by adjusting for inflation or risk. Initial investment, the upfront cost or capital required to start the project. By dividing these two, PI shows how much value you'll gain, or lose, per dollar spent. For example, a PI of 1.2 means you'll earn $1.20 for every $1 you invest. This formula is often used in conjunction with other metrics like net present value, NPV, to get a full picture of an investment's potential. It's simple math but can offer big insights when evaluating multiple opportunities. Importance of Profitability Index in investment decisions. When it comes to making smart financial choices, the Profitability Index, PI, is a key player. It's not just about crunching numbers, it's about making sense of them. This metric can help investors and managers maximize returns, allocate resources efficiently, and prioritize projects that generate the most value per dollar spent. Let's explore how PI fits into critical investment decisions. Evaluating project viability. How PI helps in assessing the potential profitability of different projects. Imagine you're evaluating several investment opportunities. Each one has its own costs, risks, and expected returns. How do you decide where to put your money? This is where the Profitability Index shines. PI simplifies complex choices by assigning a clear numerical value to each project. A PI greater than 1 means the project is likely to add value, while a PI less than 1 suggests it might not be worth the risk. This can quickly weed out poor candidates, allowing you to focus on the most promising options. It's especially useful when budgets are tight. Let's say you have $500,000 to invest but 3 potential projects, each requiring $250,000. By using PI, you can rank these projects based on their returns relative to costs. Rather than spreading resources thin or guessing, you can confidently choose the option with the highest profitability. Another advantage? PI considers the time value of money. Investments are rarely about immediate returns. Instead, cash flows often trickle in over months or years. PI helps you measure the present value of these future rewards, giving you a clearer picture of long-term profitability. In short, Pi acts like a trusted advisor, helping you make data-informed decisions even when faced with multiple competing projects. Comparison with other financial metrics. Compare Pi with metrics like net present value, NPV, and internal rate of return, IRR. While the Profitability Index is a powerful tool, it's just one piece of the financial puzzle. Other metrics like net present value, NPV, and internal rate of return, IRR, also play a big role in investment decisions. How does Pi stack up? Net present value, NPV. NPV calculates the total value an investment generates in today's dollars. While it shows whether a project adds value overall, it doesn't consider how efficiently it uses resources. Pi, on the other hand, focuses on maximizing returns per dollar spent, making it ideal for ranking projects when funds are limited. For example, a project with a $2 million NPV might look great, but if it requires $10 million upfront, its Pi could drop below 1, indicating poor efficiency. Internal rate of return, IRR. IRR represents the discount rate at which a project's NPV hits zero. It's useful for comparing the percentage return of various investments. However, IRR can sometimes lead to confusion, especially with non-standard cash flow patterns or when ranking multiple projects. Pi avoids these pitfalls by providing straightforward results that are easier to compare. Plus, Pi works seamlessly with NPV, often offering additional insights when used together. When used alongside NPV and IRR, the Profitability Index fills a unique role. It bridges the gap between total profitability, NPV, and percentage-based returns, IRR, helping decision-makers thoroughly analyze projects from multiple angles. Whether you're managing a corporate budget or evaluating personal investments, Pi gives you an extra layer of clarity. In practice, these metrics often complement one another. While Pi excels at ranking options by efficiency, NPV and IRR provide additional context about absolute returns and long-term growth. Together, they form a powerful toolkit for making sound financial choices. Calculating Profitability Index. To effectively use the Profitability Index, Pi, understanding how to calculate it is key. This process involves gathering accurate information and applying it systematically to ensure reliable results. Below, we'll explore the steps involved, from collecting data to performing the actual calculation. Collecting cash flow data. The first step? Get your cash flow numbers right. Why? Because inaccurate cash flow estimates can completely throw off your calculations. Think of these numbers as the foundation of your Pi evaluation. If they're shaky, the entire analysis will be flawed. Here's what you need. Expected future cash inflows. These are the earnings you anticipate from the investment over its life. Break this down year by year or by the relevant project periods. Initial investment cost. This is the upfront amount you'll spend to kick off the project. It includes everything from equipment to staffing to launch expenses. Double-check these figures. Use historical data, market research, or expert forecasts for better accuracy. Don't just guess, base your estimates on facts. After all, you wouldn't build a house on unstable ground, right? The same logic applies here. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.